Okay, we're just seconds away now from the release of key economic data in the United States, most notably perhaps the PCE price index number, which is a measure of price changes, i.e. inflation in the U.S. economy, often referred to as the measure that the Fed prefers, a bit more so than the consumer price index number. The expectation for those PCE index numbers is for the third quarter PCE index to come in at 2.4%. That number hasn't landed yet. What has landed is a gross domestic product number in the United States, which is greater, significantly greater than expected. Gross domestic product grew at an annualized pace in the third quarter of 5.2%, U.S. authorities now say, as opposed to the 5.0% initially reported. This is a second reading on gross domestic product growth in the United States. Again, 5.2% is the number we're seeing for third quarter annualized GDP growth. That's up from 4.9 in the second quarter, and up from the initial reading of 5.0%. Also, we do have that core PCE number now. It is less than expected. It comes in at 2.3%. So the PCE price index number comes in at a quarterly change of 2.3% in the third quarter. 2.4% was expected by economists. Nadia Lovell is our guest, of course. We spoke about this at the top of the program. Nadia believes that the PCE numbers are headed downward to a sustainable so-called two handle. Nadia, what do you think? 2.3% is the figure on that PCE price index number.
You know, this is very encouraging from a Fed policy standpoint. You're sort of having this Goldilocks situation and, you know, what's been referred to as immaculate disinflation, where you still have pretty decent economic growth and inflation normalizing back towards the 2% trend. So I think this is a positive for market. It's not too surprising to see the GDP numbers being revised up in the second read-in. I mean, you did have pretty strong consumption by the consumer in the third quarter, and you did have corporate profits, you know, and so it's not surprising to see, you know, corporate profits and GDI push up that GDP number further. We do think, as I mentioned earlier, that the momentum will slow. You can't have an economy growing at 5%, particularly the size of the U.S. economy, forever. And so we do expect that economic growth to slow, but still produce positive growth because the consumer remains in good shape. So we're looking for more in the 1 to 1.5% GDP growth for next year. And we think that that will still be supportive to the markets, particularly if the job market remains resilient, which we think that it will be. And like we noted earlier, we think that that disinflation trend is taking hold and really gaining traction, and we expect it to stay on course towards 2%. Of course, we might have some bumps along the way, but we do think over the medium term that we're on course back towards target.
We should take a look at the U.S. futures and see if they've reacted at all. Again, the core PCE price index, which is a measure of inflation. There you see the U.S. futures, not a whole lot of change. That's essentially where they were before the release of this economic data. That PCE number comes in at 2.3%. 2.4% was expected. So in essence, this is a weaker, a lower, a softer reading on U.S. inflation than economists had forecast. There's an intraday look at the S&P 500 futures contract. Your view, Nadia, that rate hikes already put in place by the U.S. Fed continue to exert downward pressure on inflation?
Yes, we know that, you know, policy acts with a lag. And so we're likely to continue to see a bit of a drag, you know, in terms of pulling down inflation and also eventually pulling down and slowing down the economy as we enter in the first half of the year. We do expect that period of subtrend economic growth to come through. And, you know, as we noted earlier, you're even starting to hear companies talk about, like, you know, easing in inflation. So it's obviously actually more broad-based, and we saw earlier this year, and it's evidence in the numbers in terms of inflation undershooting on all measures. When you think about it, in the last month or so, you have CPI, PPI, import prices, and now PCE, and so we think that trend will continue in the first half of the year. A lot of this is priced into the market at this point, and so you need to see a meaningful step down towards 2% to get a reaction from the market at this point, because the market has already expected inflation to normalize given the data that we've had recently.
Nadia,